thank you for joining us. It's close to 5 p.m. I guess you are a bit dizzy by the long, boring people speaking here. And you know what? It's going to be even more fun with risk management. That said, in practice, I hope you are not too much into the final digestion phase, and we really want to present you a real important topic. I keep having people talking to me, Yves, you know what? I've been scammed. This time 20,000. The other day, literally speaking, a guy told me I was scammed, and the person told me I should take money from the bank, a credit, to buy stuff and go crypto. And guess what? Scam. No, however, you have to repay the debt. So the big concept is that thanks to our two participants right now who will present themselves, we have concrete example on how people get protected. Please enjoy.
Hi, I'm Michael Hall. I'm the Chief Investment Officer of Nickel Digital. We're a hedge fund based in London. We manage 3 funds, a arbitrage fund, a multi-manager fund, and a DeFi liquid venture fund, which invests in level 1 blockchains like ETH, Solana, roll-ups like Optimism, and DeFi protocol tokens like Uni, Link, and so on.
Thank you, Kevin.
Hey guys, Kevin McHugh. I'm the Group Treasurer of Xapo Bank. Xapo Bank is the largest retail crypto bank in the world, and we also have one of the largest Bitcoin treasuries in the world. So we offer savings and wallet products in crypto and fiat to our customers, and we're all about providing a way to access your wealth 24/7, safe, simple, secure, and flexible. Me personally, I've been a banker for 20 years, JP Morgan, Deutsche Bank, and Bear Stearns. I've been through lots of crises and stresses and 2008, etc. And what I'm really looking to do is bring that experience, into my new role in Xapo, and take the learnings from, TradFi and all the experience there, bring that into building, a safer, ecosystem for crypto and digital assets.
Lovely. The key point is, when you look at the keyword IRM, in French, it's a medical device. So basically, Michael, how would you define investment risk management?
Okay, so I want to look at the title here, which is Institutional Risk Management. And so, well, firstly, what do we mean by an institution? So our funds have a minimum $1 million investment amount. So that cuts out a lot of retail investors. But you can still have retail investors who have more than $1 million, and they're still retail investors. So an institution is a company set up specifically to make investments, like family offices, fund of funds. It could be bank asset allocators, like JP Morgan Investment Management. It can be endowments and pension funds. And we have money in our funds from all of these different categories of institutions. So that's what we mean by institutional. Now, what do they look for when they're doing risk management? Because they're putting in more than like $100 or $1,000. They're putting in at least $1 million. So what do they want to see? Well, the first thing they want to see is they want to see a regulated fund. So we're based in London, which means we're regulated by the FCA. We have US investors, which means you're regulated by the NFA. And that gives them some level of comfort that we've got a big compliance oversight over us. The second thing they want to see is somebody checking. So KPMG is the only Big Four auditor who audits Cayman crypto funds. Our funds are based there. And so we've got 4 years now of audits from KPMG. And every month, a European regulated fund administrator checks what we've done in that month and publishes a monthly net asset value, which is like a statement of our balance sheet that shows how much we made or lost. So they look for regulation, they look for checks. They also look for infrastructure. And by infrastructure, I mean everything from trading systems to portfolio management systems to risk management systems, but also what banks you have. So for example, last year we had a couple of banks. 2 weeks later, we had 0 banks. Now we have 3 banks, all based in different places to avoid what happened last year. The other thing which they don't like is self-custody. So when the fund manager custodies the assets themselves. So we use regulated custodians like Fidelity, Copper, and the technology behind Fireblocks, which is technically not a custodian. Apologies to Fireblocks, but that's what people tell us. And those are the things the institutional investors look for. So they look for infrastructure, they look for regulation, they look for checks. And when we come on, and that's even before we started to talk about risk management. So what is risk management? Well, it's two things. It's return of capital and return on capital. And return on capital means you're going to get your money back. And so that means you're using things like off-exchange settlement, so you don't have to put your money on an exchange to trade it there. So Binance has Cefu, Copper has Clearloop, and so on. And the other thing is return on capital. And in the funds we run that are market neutral, they want to see that we manage our risk. They want to see that we're making sure that the managers to whom we allocate capital to are market neutral and they don't stray away from that. So we have a risk management system that monitors all these external managers who are trading from California through to Barcelona, through to Singapore. We have 20 managers all around the world, none in our office, but every 30 seconds we check their positions on the accounts that we control to make sure all the risk is under control. So that's kind of a long answer to institutional risk management.
Thank you for the great detail. Kevin, would you further implement your discussion? How do you apply it in Xapo?
Yeah, so I mean, a great question. So I work for a regulated bank, right? And I've been at the coalface of risk management for a long time. And the question is, what is risk management, or how do banks do risk management? It's really about discipline and structure. It starts from the top down with governance. It's about embedding risk disciplines in every part of the business, so that there's an old cliche in banking that everyone is a risk manager. But it's a lot of grind, right? Exhaustively going through, thinking about every possible risk that the organization, the institution could be exposed to. Risk to capital, risk to liquidity, market risks from exposures to currency, interest rate risk, operational risks, payment risks. And it's exhaustive to go through and think about all of these things. You bring together all the different parts of the organization and you have that discussion. You have monthly risk committees where it's an open space where people can talk about the risks and speak up, identify things that they're concerned about. You track it with KPIs. You can do heat maps. How are we progressing against these risks? There is a lot of block and tackle in risk management that happens behind the scenes, and that's really what we need more of in digital assets and in crypto. As Michael has mentioned, there's been a spate of banks going down in crypto last year. You can have a great business model and terrible. You can have a great idea but terrible risk management, and vice versa. You can have great risk management and not a great idea. So there's a lot of block and tackle and grind in building those systems. But once they're in place, everybody in the organization understands how they work, and you've got a framework for having those discussions.
So actually, when you say we have so much risk to monitor, the way you do it with people, time, energy, money, sweat, blood, and whatever you can imagine, I have the impression that the people who do risk management are kind of psychopaths. Be careful, maybe there's going to be a rock behind it and we're going to have an accident. And actually, that's what happened with FTX. So in practice, do you think that this perfect storm will happen again? And what did you do in the business to protect yourself and especially your customers?
So absolutely FTX will happen again, or FTX-like things will happen again. We've seen fraud in TradFi, so you look at Madoff. You've had in crypto exchanges, CoinFlex has gone bust, and there have been several others. So absolutely, we will have exchanges go bust. What can you do about that? Well, you can not put your money on the exchange. You can use off-exchange settlement to trade on the exchange without having your money there. And every 24 hours, you settle your P&L to the exchange. Other things you can do is you can buy some insurance. So our DeFi fund bought some insurance from Nexus Mutual. Now, unfortunately, Nexus Mutual doesn't offer that kind of insurance anymore, probably because we bought it at 2.6%. So go figure. Buying insurance on FTX, annualized, 2.6%. That was the deal of the century. So things like FTX will happen again, but it's up to funds to protect themselves, investors to be informed, and look for solutions such that if there is fraud, they're protected.
Amazing. So the key question is, well, you have concept. You have people making, as I told you, the psychopaths. Maybe there's something impossible that's going to happen. FTX. The key question is that today, do you think there's a proper way for a bank to manage both the so-called access keys and who is doing what, the due diligence? How do you do it in your bank?
Well, key management is vital for any organization that's operating in the digital asset space. The gold standard of MPC, multi-party computation, is and those standards are even improving, right? There's new MPC CPM that's going to offer faster throughput. That's what I would say to that.
Because if you're not into geeky stuff, which I perfectly understand, there's a company called Fireblocks which protect you, at least technically, on plenty of aspects. Please have a look, they're just there. What really is interesting for us is how expensive those protection tools are opposed to the risk undertaken in your company.
So those tools, I don't want to give away too much commercial information about how much they charge, but depending on how much money you have with them, they charge from 50 basis points to around 10 basis points.
So for a basis point is a percent of a percent. So when you put 10,000 euro in the bank, it will cost you 1.
Sorry, so just to be a basis point, 0.5% is 50 basis points. So everyone's clear on what a basis point is. But it's worth it, because when you do that, you can guarantee that your assets are protected by a professional custodian. Does that answer your question?
It does. So my key question is that all around the table here, they want to know, why should I go into your bank? What is your USP? Unique selling point.
So look, I think one of the things that is not as well known is that we are custodians of one of the largest Bitcoin treasury in the world. We have over 10 years of experience. We have grown from being a Bitcoin wallet into being an e-money provider, and now we're a fully regulated, crypto bank. We have great products enabling you to access your money, to transact in stablecoin, and even the Wall Street Journal called us the Fort Knox of Bitcoin. At one point. At one point, we had over 800,000 Bitcoin in custody. So we have a deep experience of, from key management, wallet management, and now we're adding that real institutional, regulated layer. And really, we want people to be able to have a safe space to store their crypto and their fiat, but also to transact. Because there's no use having your digital assets under the bed. You also want to be able to interact, receive payments, stable coins, if you're a digital nomad. Those are all the reasons that having all this capability and product in one app in your fingertips is so much better than keeping your money on a cold wallet. And I think that is really what we are bringing, because that experience that we've got over those 10 years of being a wallet and on our evolution, we've learned and listened to our customers, and this is what we've built a product for them.
Well, I guess my wonderful euros below my mattress will not stay there for so long. Please trust, people at Ledger does not exactly comply with this approach. We have different possibilities. Depends. What is your USP in your bank?
So we're not a bank, we're a hedge fund.
Same.
But our USP, so we're not trying to get crypto whales who own lots of Bitcoin to invest in our fund. We're trying to get people who would never touch crypto, who think it's risky, think it's dodgy, think it's full of cowboys and crooks. We're trying to get those people to invest in strategies, in digital assets that will make them money. When we started our arbitrage fund back in 2019, a lot of our investors said to us, this crypto stuff is a scam, but we can see how you can make money out of it. So here's some money, so you can go and make money from arbitraging these crypto exchanges and stuff. So what we sell to our investors, our institutional investors, is that we can make the money in digital assets and protect that money. And that's basically what we've been able to do in the 4 years we've been operating.
That's absolutely amazing. Please tell me, right now we're in the era of AI, generative one if possible. Do you think that in your business it's useful to apply it and offer services mixing crypto and AI?
Well, I think that because with blockchain-based, because we are operating on public blockchains, I think AI has a much, is going to be incredibly useful in terms of identifying, wallets, addresses that have been hacked, tracing transactions. You can see how AI will really help. It really kind of works with public blockchains to identify places where you don't want to be sending. From our perspective, we want to protect our customers. We have a couple of different angles. We want to protect ourselves from onboarding, customers who are going to be, bad actors. But also, we want to protect our customers, and those kind of tools can really help us, make sure that, a customer doesn't send their coins to somewhere that they really don't want to send their coins to.
In the case of AI, usually when you have to put some decision-making process, it leverage issue, legally speaking. Who made the decision? Especially when I was working on a hedge fund, they said, well, it's an algorithm who did it. So we got a problem. When they're the problem, who's to blame? Do you have such issues expected in your business as a hedge fund?
Yeah, so we use AI itself. AI you can break up into it's many different areas. It's not just the large language models that have recently got a lot of press, like ChatGPT and so on. So we've been using neural networks, and the managers to whom we allocate money, we know are also using neural networks to analyze markets, look for patterns, look for trading opportunities. But these black boxes, a lot of the people who are running the neural networks don't actually know the coefficients of each node in the neural network, but they don't necessarily know why that coefficient is the level it's at. They don't understand why the brain thinks what it does, because there are just too many nodes, there are just too many things to understand. So that's why you need to put a lot of risk management on this, and it's really simple. Maybe the model was trained in a different environment, and it only makes money in certain environments. And so if the model stops working, you have to decrease its capital very, very quickly. And that's where risk management, just really simple. Nothing fancy, drawdowns, when the model starts, you can notice performance start to come off track with high frequency models. You just start reducing its capital. So it's that simple.
Thank you very much. The key aspect, we want you to understand that your money is safe by Xapo Bank, or eventually if you have even more money, possibly you can lend it to the hedge fund. Thank you for joining today, and please feel free to contact our great speakers if you have key questions. Next time, see you.
Thank you.